All right, so welcome back into the live stream today. We're going to be jumping into Bitcoin. Obviously, as everybody is watching the charts this morning, we are seeing a little bit of a red day, we'll say it, and it's going to be a topic for, I think, discussion. Anytime we do see these kinds of days occurring, typically we always kind of jump to conclusions of, is this the period in which we're going to see Bitcoin and other digital assets really start to take a negative move in the market? We'll dive into all that. I've got a couple of special guests that will really break this down. My name is Paul Barron. Welcome back into TechPath. As you guys know, we cover all sorts of things from a TA analysis side as we look at crypto in depth every day here. If you're new into cryptocurrency, maybe you're new into just blockchain and understanding the technology that is the underlying component of all of what's happening out there, make sure and subscribe to the show. You'll get a chance to learn a lot about different projects, obviously about the blockchain narrative itself, and then we do dive into a lot of stuff around Web3. This is going to be an interesting one because we've asked a couple of guys come on the show to really kind of break down the potential of where Bitcoin could be flowing. And there's been, as you guys have talked and seen on our show, is we've been leaning into this narrative for a little bit. Now, Gareth Soloway, who's one of our analysts that comes in on the show quite a bit, he and I do kind of our macro markets analysis every other Monday. And over the past couple of weeks, this has been one of the indicators that has been following in. The guests today are kind of breaking this down in a lot of similar ways. So I want to introduce Patrick Karim and also Kevin Wadsworth, who are coming in from Northstar and Badcharts. So great to have you guys on the show.
Great to be here, Paul.
Excellent. All right, so let's get into it. So
this has been one of the indicators that have been following.
Yeah.
The guests.
So we're getting some feedback from one.
Yeah, that was me, I think.
Don't worry about it. There's
So
a
sorry.
delay there on the live. Not a problem. It can happen. So let's get into it today, guys, around the current thesis of where Bitcoin's trends are going. Now, you guys have been on a couple of shows out there kind of breaking down a little bit of the chart analysis that you've presented over the last few months. And I want to get into a couple of things that really talk about where you see the current charts kind of pushing Bitcoin. Obviously, the rest of the market in terms of crypto will start to follow. We'll also talk a little bit about the decoupling of crypto from the traditional finance markets as well. But let's kind of jump into it. Let's start with you, Kevin, and just kind of give me a breakdown of where your position is pointing currently, at least based on what you guys have been doing in terms of research.
Yeah, sure, Paul. I hope everybody listening to this isn't getting too much feedback because I can hear that at my end as well. So I'll just persevere and carry on anyway. I mean, what I want to just get out of the way first, and if it's okay for me to share my screen, I'll do that, is to explain to everyone that's watching this just how myself and Patrick go about our technical analysis. I've had 34 years in forecasting for the military in the UK, and emergency responders in the world of weather forecasting. And it's very similar to the techniques that we're applying here with the technical chart analysis. We take the current situation that we have at the moment and all the known variables, and we project it into the future. So all methods of forecasting scientifically are done this way. You take all of the knowledge that you have at the moment about the market. So you're talking about Bitcoin, you're talking about all of the technical chart analysis and all the features of what's going on with the price chart of Bitcoin at the moment. And you can project that into the future. But what you end up with is a whole range of possible outcomes. So as you're talking at the moment, we could see Bitcoin going up to 40, 50,000. You could see Bitcoin dropping down to 10 or 15,000. You don't need me to tell you that. So there's a range of possible outcomes. It's just that some of those outcomes are more likely than others. And as traders, as investors, we want to focus on what is most likely to occur and what is the most likely outcome. So if I can just move on this slide and just explain to you that gathering the evidence, we take a whole range of predictions, both myself and Patrick, and we look at a whole range of technical chart analysis techniques. And by doing that, we can use a technique about a little bit like this one here for forecasting future temperature. And you end up with a cluster of predictions a few days from now, forecasting what the temperature is going to be. Well, you can do the same with Bitcoin. You can get a range of predictions and forecasts from a range of different techniques. So you've probably heard of cycle analysis, Elliott wave theory, You've probably heard of some of the indicators like the stochastic RSI. You've heard of breakouts, breakdowns, bullish wedges, all that kind of stuff, volume analysis profiling and all that kind of stuff. And when you look at all these individual pieces of the puzzle, it begins to paint a picture, and some parts of the puzzle point in one direction, some point in another direction, but when they all cluster together and they're all telling pretty much the same story, you can have high levels of confidence that that particular forecast is going to pan out. So there are times when you can be quite confident, and there are times when the confidence levels drop. This is just a little example of how that was done with gold, but we'll move on to Bitcoin straight away, I think. But you can see here with this example that we were able to forecast accurately 3 years ahead of time what the price of gold was going to be doing. Moving more specifically onto Bitcoin and what we're expecting for the future of Bitcoin, and just advancing through the charts here. So this is a chart which I'm going to ask everybody watching this broadcast at the moment to take a good look at and tell me if they think it's bullish or bearish. I mean, what's your gut feeling looking at that, Paul?
Well, I mean, when we look at the charts like this, obviously right now, what we've been kind of considering is a lot of the precursor to what we study, which is mostly sentiment, which is a downtrend. And downtrends, obviously, we've seen small bear runs here recently. But I'm intrigued in terms of how deep this trend could cut, because when I looked at your initial charts, I was a bit surprised at how far into Bitcoin in terms of a downtrend you guys were predicting.
Yeah, sure. And that's what this chart here is helping to demonstrate. I think if this is a technique used to try and eliminate bias. So looking at this chart here, you can see a number of indicators on it that suggest that the next move is going to be to the upside towards the target zone. It's a typical basing pattern with a breakout. You can see the little stars there clustered on the bottom right-hand corner there, and that's an indication of various technical things being achieved that tell us that the price is going to go up. And of course, the price did go up, and we now have a bull flag forming. So this particular chart looks very, very bullish. But then if I tell you that this is the Bitcoin chart, okay, and this is what the Bitcoin chart actually looks like, all I did there was I flipped the chart upside down. So what you were looking at a moment ago was the Bitcoin chart upside down, looking very bullish. But this is the Bitcoin chart as we prepared this slide for you a couple of days ago, and it shows the Bitcoin chart looking very bearish. Now, you don't need me to tell you what's happened since we sent this chart to you a couple of days ago to have a look at. This pattern has broken to the downside. So the technical analysis has given us a heads up what was going to happen next. And this bear flag on this chart, those little two dotted black lines that are rising up, that's a bear flag, and that's telling us the price is more likely than not to break down. We're below the key moving averages, and we're below the resistance line created by this geometrically perfect arc. So as long as that remains the case, the probabilities continue for Bitcoin to move to the downside. You can see the target zone. The target zone is anywhere between about $9,000 and $12,000. So at the moment, the technical chart analysis, for a whole variety of reasons, is saying that the most likely destination for Bitcoin in the next, I would say, sort of 4, 6, 8 weeks is that sort of 10 to 12,000 zone. The only thing that will change that prediction is if the chart breaks out. And by say breakout, I mean it has to get outside of that arc, and it has to get above the green line as well, the 200-day moving average.
Yeah. So so the comparison here, obviously, with charts like this, is the typical scenario that we break into. Is most of this stuff is driven obviously by price action, which is driven by just investor sentiment. We've seen this, time and time again, where a lot of this is really kind of led in by macro positions in the market itself. When you look at the macro environment as it is, whether it is CPI, interest, implications as we start to see an FOMC result here coming up next month, or we see things changing in Europe, when a stand of kind of understanding the macro effects of what's happening right now, where do you guys see this happening, or do you see this continuing to get additional pressure? Let's play this out into a narrative. Let's say that, for instance, we do print a positive CPI, meaning up from our most recent print, and potentially a 75 basis points increase in September. If that plays out, granted, other narratives that come into play are things like ETH merge, all that kind of stuff that kind of tests consumer and retail confidence. Would that hold up in comparison to what you guys have seen so far in other aspects of your charting?
Kevin, you've disappeared, Kevin. You're just a shared
I'm
screen.
just a chart.
I wasn't sure if you might want to talk about that chart, Patrick, but I will. I'll make myself reappear.
We prepared a whole bunch of slides, but we could come back to that one after. But I'll tell you two things about what drives what, Paul, and I have some charts to show this right after. So, because charts are great, just like to crystallize an image, right? Because sometimes we have a story, a narrative, but it floats in the air, right? But when you see a chart, it really, for a lot of people, especially for me and Kevin, it really crystallizes this is what's happening. And the more data you have, the higher the sampling rate, the more efficient you are.
Right.
Just like Kevin showed your first chart and how like probabilities and all that, you need a lot of data. So what primarily drives price is capital flows. So there's a pretty much two type of asset classes. There's the growth stocks, tech stocks, etc. I'll show you the charts after, Paul. Until proven otherwise, Bitcoin is part of those growth, speculation, tech stocks. Because as we know, like Bitcoin started getting traded in 2011, but what people don't understand is 2011 was the beginning of the tech bubble. So we don't have data before. So it's kind of weird. People think that the Bitcoin cycles, they have to go over and over and over just based on the Bitcoin chart itself. But if you take a step back and look at macro, and I'll show you those charts right after, guys, and people understand, you'll see exactly where you are. And once you know that, these smaller cycles that Bitcoin's been living through, but when you take in the macro landscape of capital flows defined by growth stocks divided by inflation or PPI, producer price index, which is a non-hedonic adjusted way to see inflation. It's the input cost of everybody who's producing goods, right? So copper price, electricity price, all the producers, their actual costs, that's a great proxy for inflation. So when the producer price index starts outperforming the SPX, which is majorly tech stocks to 25%, it barely has any energy or basic materials, it's like 5 or 8% of it. That means the capital flows are starting to leave for X reason. Hedge fund managers, people managing billions of dollars, they say, hold on here, my margins, the growth stocks, the P&Es are starting to shrink. I can't allocate my money that much in that. And solely some of that capital is going into commodities, anything hard, right? If it drops on your foot and makes you pain, Paul, that's like the money's going to there. So once that shift happens, the capital flows change, that drives a price. So anything we've seen, so let's say when the NASDAQ bubble started, it was actually in 2011, it was SPX or the NASDAQ starting to break out versus gold, versus silver, versus all these commodities. The capital flows started driving the price of the assets in the NASDAQ, and that drives the narratives. Because the way is, you cannot have a narrative before the price moves. It's like a story. There's no story if the adventurer didn't get to the castle and slay the dragon, right? There's no story. Charts will tell you before the story starts at the base, before like the epilogue, is that the prologue, right? Before the movie, charts will tell you that base. And then you'll see when that capital shift breaks in favor of an asset class, whether it's growth stocks or value stocks, then you'll be able to get in. Because that's the thing, when Bitcoin people, you see Michael Saylor, best performing asset, it went up 10,000%, 100,000%. But that's you living in the past. That's your FOMO, or all the crowd reads that and see these great gains, but those are gains that happened in the past. And you want to be before those gains happen. That's the story that unfolded before, right? So I could share my screen maybe to right now just to show some charts about, just to show you guys where the macros are.
I'd like to see definitely see the macro overlay for sure. Let's take a look here.
Okay, I'll show you a few charts. So right here, this is the NASDAQ. So the lines in the back here. Do you see my moving cursor, guys?
Yep.
That's a NASDAQ divided by the producer price index. So this is called a sleep mode line. It's a strong angle of ascent. It's a strong momentum in favor of NASDAQ and tech stocks. So this was the .com bubble. And here, blow off top. So that's NASDAQ outpacing inflation. Like, you don't want to hold any gold. You don't want to hold anything when the NASDAQ's performing that well. That means the capital flows are going into tech stocks. As soon as that breaks down, then the momentum has shifted. You don't know if it's going to bounce back up, but in this case, in .com bubble, it was just a huge underperformance of the NASDAQ and a huge outperformance of inflation. And we all know that gold, silver, all that stuff, the oil, they did great from 2000 all the way to 2011 when the NASDAQ broke out versus inflation of this early breakout line, and then it stumbled a little bit. But then in 2012, it did a horizontal, I could have drawn a horizontal line here. It broke out. You go low gold, low silver, low oil, and you go heavy on NASDAQ right here. Right here, I have the Bitcoin chart right here, right under, Paul. And you'll see that Bitcoin, we don't have history previous to this cycle. It started right at the beginning, and it's just tracking this rising trend, of course, with more volatility.
Right.
But overall, it's starting to define some rising trend lines. And each of these trend lines, the more acute they are, that means the momentum is going up really powerful. But once these trend lines are broken, that means the momentum is slowing down. So even if the price goes up for Bitcoin, it's not going as fast as it did in its previously. And now Bitcoin actually broke down 1, 2, 3, 4, 5, 6. This is a very valid trend line, and it broke down below that. So the momentum is slowing down. It's not, you want to go in the train who's leaving the station, which is garnering momentum like it did back in 2011, like NASDAQ. That's where you want to be. You don't want to be when the momentum's slowing down, because even if it does go up, Paul, you're not putting the odds in your favor when you're going into an asset class which has ran for 10 years, did great returns, and it's starting to slow down. And right now we see the NASDAQ also has definitely broken down of a rising trend line versus PPI. And I'll just show you one more, just this one. So this is the big picture chart. So I don't have NASDAQ going back to 1914, but the SPX is pretty much, it tracks pretty much the NASDAQ. It's the top 500 companies, and right now they're mostly tech stocks. So here's a cycle that broke down of this rising trend line. So this is SPX divided by, adjusted for the inflation or producer price index. 1, 2, beautiful rising trend line, beautiful 7-year moving average, broke down close below both. For me, that's a clear breakdown of momentum. So even if SPX has a rally, and this chart dates from July 13th, even if the SPX has a rally versus inflation, until it does either a new high or closes above what I call an early breakout line, eventually there probably going to be some retests here, you're not on the good side of the train. And here is the same break from the 1980, the legendary 1980s US equities bull era, when it broke down, same time as NASDAQ. You don't want to be long anything that's US growth stocks right here. And I'll bring this is what people don't see. This is the cycle that happened, the Nifty 50, right? From 1950 went all the way up to 1969. US equities were invincible. And what happened? Once again, 1, 2, 3, 4, 5, a rising trend line, perfectly broken, momentum slowing down. And after that, there's an echo bubble, but it cannot do a new high. And then after that, you're just vulnerable. You're just on the wrong part. And this happened, what? It happened again. It happened in 1920s, beautiful bull run for US equities, it broke down versus inflation. So you just, from a risk to reward perspective, the rallies should be sold here. Anything that's tech stock, anything that's Bitcoin, until they could prove otherwise, you sell those rallies until these early breakout lines, like these ones here, until they're broken out, until you get like a little star here and you're above a 7-year moving average. That's when you get on. That's when you get back on the train.
Yeah.
Because anything else is
Okay.
just guesswork, isn't it?
Right. So, I mean, when you look at historical charts, and we've seen these before, they do align well with exactly kind of the thesis that you guys are presenting. One of the things that I always kind of look at, not only from a historical standpoint, is that though we've had those kinds of scenarios play out really since the 1920s, the difference obviously really kind of changed in, really around 2012. And the implementation of digital assets, cryptocurrency, creating pretty much a new asset class has started to create a new dynamic, at least in one that we've studied here quite in depth. When you look at the traditional securities assets, gold, silver, obviously going into bonds, etc., those have been asset classes that have been around for decades. Digital currency, digital assets start to flow into, not even to mention where NFTs and the evolution of what extended digital assets will look like. To me, this starts to really muddy the water because it's a new player, it's a new fish, a new whale. in the pool that starts to really kind of recreate the process of how charts may look in the future. In essence, if we see a new additive, which we do now with digital assets coming into the game, along with macro scenarios that are really kind of pressuring, I guess the big question for us that we ask a lot on this channel is, when is that decoupling potentially going to happen? If and when that does occur, if digital assets truly decouple, much like gold has done in the past, could we see a completely different narrative start to paint out? In other words, history now begins going forward rather than looking back at history in which these assets were never a part of. So those are the kind of scenarios that I look at in trying to break this down. Obviously, we talk to hundreds of analysts a year. We dive into macro, we dive into technical sentiment, all these kinds of tool sets that are out there. But as you mentioned, price action is really kind of the king of the hill, because it's essentially what drives the market no matter what. If you look at this article here from CoinDesk, obviously we've seen Bitcoin kind of, let me pull that up just a little bit. Bitcoin take another red position. Fridays have always been notorious for this. Ethereum's situation is a little unique in the fact that it's entering a merge zone. Potentially we'll see Ethereum. We have already kind of talked a little bit about what could push Bitcoin down under maybe 15K. My question is, with the charts kind of showing that we could see a real 10K number, is there any risk here based on what you've seen, both from a macro environment and then from a historical side of things, that could push Bitcoin further than 10K based on the thesis that you guys are in right now?
Absolutely. Yes, absolutely. And you have to bear in mind that cryptocurrencies haven't existed during a period like, for example, the 1970s. If you take a look at the 1970s, we had multiple years, in fact, a couple of decades, where the stock markets seriously underperformed inflation. So that was obviously during the very well-known precious metals bull era, but we didn't have cryptocurrencies back during that period. And so what we don't know as analysts, or what none of us can know for sure yet, is just how cryptocurrencies are going to behave if and when we have a protracted stock market bear market that goes on for year after year after year after year,
Right,
as it did in the 1970s. And you have to bear in mind that quite a lot of similarities between what's happening today and what happened in the 1970s. We have a real energy crisis here in Europe, where I am. We have runaway inflation. We have double-digit inflation across multiple countries, heading towards 15, 20% in some countries in and around Europe at the moment. Turkey, for example, is up near 100% inflation. And this is accelerating rapidly due to the energy crisis that's been caused by a number of factors, which we don't need to talk about here, but very strong similarities with the reasons for the problems in the 1970s with the Yom Kippur War, which triggered the rising of oil prices, which triggered the inflationary issues that we saw during the 1970s in certain countries. Of course, what's happening today is far more globalized, and the entire European Union, the EU trading bloc, is involved in this problem, which makes it everybody's problem, essentially. So if we see a repeat of the 1970s, where the stock markets go into a sideways or downwards trending kind of pattern for the next, let's say, 10 years, then, as Patrick's already explained, until proven otherwise, cryptocurrencies are acting like a tech stock and acting like the NASDAQ and acting like the SPX effectively. So the charts will tell us, they will tell us when that decoupling happens, if that decoupling happens and cryptocurrencies or gold or anything else breaks away from what the stock markets are doing, then the TA will tell us that. But we have to respect the fact that we have to wait, we have to be patient. The 200-day moving average, the declining weekly defined trend line, there are certain technical elements that have to be achieved before we can be have any even small degree of confidence that that's happening. For the time being, we are just following this downward path, and we don't know. It could go to 10, it could go to 5,000. Heck, I mean, it could go 2,000, 1,000. Who knows? We just don't know the answer to that. All we know is the path is still down.
So, okay.
Well, can I add something there? Sorry.
Yeah, sure. Go ahead, Patrick.
I try to mention this is another thing that people are going to have to start doing when the SPX breaks down versus the PPI. So let's say you've defined the macro landscape as defined by that ratio chart, and then you say, okay, I'm in an inflationary cycle, and often there are more recessions. There's like 2 to 4 recessions in those 10-year periods in these previous inflationary cycles, while there are less recessions when the SPX is outperforming PPI and they're shallow, right? People are even, let's say Bitcoin does go up, Paul, but it goes up at a lesser rate than a commodity.
Sure.
Do you still want to hold it? Because this was what could happen if they open the spigots to save U.S. equities, to keep them nominally afloat. Okay, they're adding zero, so they're able to maintain the SPX at 4,000, 5,000, trying to keep those previous highs. But gold, silver, all these commodities, they're going to price in the loss of purchasing power. They've been proven, gold has been proven that like to track inflation power loss, like almost to perfection for 100 years.
Right.
You want to measure Bitcoin in something other than fiat, because if the fiat's going to zero and Bitcoin's going up, but it's not able to outperform another asset, that's also a reason maybe not to hold it, And I just got to mention this though. The price, when it's like, I think some people sometimes they confound the usage of something with what the market values it, because it's all defined by capital flows. If the market decides there's not a lot of inflation and PEs can expand to crazy levels, that company that was there in the previous cycle and just happens to get a haircut in its price, it's still the same company. It's still creating paper,
Yeah.
still doing whatever it's doing. So if you love Bitcoin for a way to transfer money, or you like holding it because whatever, you're out of the grid, fine. You shouldn't let the value of what the market is pricing it in decide if you want to use it or not. And people sometimes they get attached to the price. Oh, price going up. It's the market validating the usage of the product. It has nothing to do with that. It could coincide, but that's going to make you a hodler when you shouldn't be holding when that price goes down, right? So it's like, yeah. I just want people to understand what the price is and what the value is of whatever it is. They're two different things. Sometimes they match, but it could happen they can't match for 10 years. So
right. Well, and one thing that I do quite a bit is we study consumer science, have done this for over a decade, looking at just how markets move and how, brands are built, how it affects potential trillion-dollar marketplaces, both on uptrends, downtrends. One thing that is unique about this particular cycle to me, and I just wanted to kind of reference a couple of tweets here. This is one coming in from Crypto Whale. It took 2 months to rise to 20%. 2 days, obviously, we've crashed and reversed that. Bear market is strong. Obviously, once enough of people are kind of, lured into these fake out rallies, that's when we're going to see this kind of this rug pull. The scenario that plays into these things, to me, again, gets back into an unmeasured entity, much like what is digital assets, an unmeasured entity for historical charting. The other thing that's an unmeasured entity for me is the investor breakout classes that have started to occur. We've already seen Wall Street Bets, the evolution of how that really affected the stock market. We saw how it was able to put some pressure on shorts. And all of that is driven from a millennial investor that is really replacing or supplanting a Gen X and boomer investor as we start to see these cycles out. Now, sure, these things will take some time, but the reality is I think some of the volatility, and especially the definition of crypto in general, I think is being driven a lot by a new mindset from an investor class that has, again, not been measured before. So we've measured boomers for 4 decades. We've measured Gen X's for 3 decades. We've measured millennials for the first decade. So the number one asset class that these millennials are essentially entertained by is none other than growth stocks and cryptocurrencies. So I guess that would be my argument if I was looking at, because obviously investors, whether it's retail and or if they get into a position of where they're managing money, obviously their mindset is done in very similar asset, processes that really kind of change the dynamic of how they go into the marketplace. So I'm still kind of questioning all of these kinds of scenarios. Sure, I believe we're going to see some downward trend, but I think it's more macro driven than anything versus, say, historical. But I do, and I'm very intrigued by how you guys have charted this out over the past couple of decades to really kind of showcase what's happening here. One question I have for you, Kevin, is, and you mentioned this because obviously you're in Europe. when you look at the European landscape and what's happening in Ukraine, we obviously are going to see kind of a stop sign standing right now in the country of Germany in terms of just the issue with heat within the winter. If we do see some of the pressure pulled off of the theater that is happening within Europe right now, and we start to see at least a glimmer of hope on the other side, would that change your position if we started to see a little loosening, possibly a scenario where European countries would re-engage with Russia in terms of gas? What kind of position would that change?
We have a real, real disastrous situation unfolding in Germany. I mean, I've been tracking this since last year, and the mainstream media just didn't seem to want to pay it any attention at all when the breakout happened for the PPI in Germany, and then the PPI went beyond what it was in the 1970s, and there was still nothing in the mainstream media. And then the producer price index for Germany went beyond the post World War II near apocalyptic peak of producer price indices, and it reached that level, and still there was very, very little in the mainstream media. Energy prices have followed suit, and wholesale gas and electricity costs are, they went 2 times, 3 times, 4 times, 5 times, 6 times, 10 times the previous base levels that they'd been at. So we have a truly horrific, and I'm not one to kind of sensationalize things, but what's unfolding now right across Europe, and not just Germany, France, Italy, Spain, Holland, Poland, the United Kingdom, we're all seeing this now with energy prices at levels that are not feasible for the consumer or industry to pay.
Yeah.
So we are going to need some kind of Europe-wide bailout program, some Europe-wide agreement to get through the winter, because there just is not enough gas stored across the European continent to supply Europe unless, as you say, Russia turns on the gas again. I think the Nord Stream is down to 20% or less of its capacity, and unless Putin has a change of heart here, we have an apocalyptic scenario developing. In your situation, in your scenario that you just painted there, where Putin suddenly says, "Yeah, okay, well, I'm going to be friendly. I'm going to turn the gas back on," then that's clearly going to have a knee-jerk reaction in the markets. But the effects already of what's happened, and the locked-in energy prices and the producer price index,
Right.
they're going to take months and months and months to feed down the line. And the simple answer to your question there is, until the charts confirm it, and until the charts have those breakouts, then there is no reason to assume that anything good is going to happen. And going back to Bitcoin, we'll know that something is afoot if the price drops below approximately 12,000, because
Yes.
typical retraces in a bear market, I think we all know, around about that 85% level.
Mm-hmm.
So I think that's one reason why everyone's looking at that sort of 12, 13, 14, 15,000 level. And if we start to slip below that, and we know we've got something different going on, we know we've got serious trouble, and we know that perhaps the millennials and the younger generation who are very much into cryptocurrencies are perhaps much more fickle and are turning their backs on it because they've been burnt and lost a lot of money. I mean, speaking to the younger generation that I know, my children and their friends are in their 20s, and a lot of them have lost a lot of money. And if they don't get it back fairly quickly, they are going to never touch cryptocurrencies again. I can tell you that for certain. So what I'm saying is that if this needs to be a normal cycle for cryptocurrencies to avoid a really serious issue here, because if we don't have a normal fourth cycle for Bitcoin, with the bottom being achieved sometime between let's say the fourth quarter of this year and the first quarter of next year, and prices turning up throughout the rest of next year, if we don't have that, then we've got serious issues with cryptocurrencies and with broader markets that would tend to confirm that we are in a situation like the 1970s, and we have a lost decade as far as the broader equities markets are concerned, and quite possibly cryptocurrencies not decoupling and suffering the same fate. It's hard for many to imagine, and I understand that a lot of cryptocurrency traders will be shouting at their screen saying, "Kevin, that's impossible." And I agree, it sounds impossible, but once that chart crosses the boundary and it crosses the 200-day moving average, and we get above that weekly defined declining resistance line, great, I can be on board with it again. But until then, I'm afraid it's a risk. And yet, as a meteorologist and a scientist, I've learned one thing: if there's a 1% chance of something happening, don't ever rule it out, because every day of the week there are things happening all around us that have a 1% chance of happening. There's a 1% chance of a terrible accident happening to somebody or whatever. These things happen all the time. So do not, please, I know you're shouting at the screen, some of you, but do not disregard 1% probabilities.
Patrick, last up here, I want to get this in before we wrap up here. Obviously, you being in Canada, we've seen some pretty big changes within the policy there within Canada. They just released here recently about a cap on altcoins. Obviously, this will affect the markets in a very interesting way. When you look at, because Canada has really kind of been looked at as one of the innovators overall, what is the political environment there right now within Canada? Because I feel like Canada is still a very big player when you look at their global position, especially from the financial markets. Do you see more continued pressure from the regulators there within the digital asset space, or do you think this is more of a scenario that they're trying to make room for traditional finance?
I don't have much of tracking of that macro information from that level, because sometimes I have a feeling that whatever the politicians, whatever they decide, they're kind of guided by those macro flows that were defined. Let's say we're going to inflationary cycle, they'll change your speech. Because sometimes, did you ever do the exercise of taking a bit of news, whatever it is? Let's say, I don't know, Bitcoin goes up 8% and something else is happening. They'll say, oh, Bitcoin goes up amidst recession talks. But after that, the same type of news, and let's say in inflationary talks instead of recession, oh, Bitcoin goes up despite. So I'm trying to stay agnostic of all the news, because for me to stay focused, to try always to trap the big picture, trap the macro tidal waves, which move the price action, which I could actually make money and try to ride that trend. I have a feeling that when we hear the news, it could be spun either way. Whatever the government does right now, if they would have done those type of flip-flops, but we were in 2011, and let's say they said, oh, we're going to start regulating Bitcoin altcoins in 2011 or 12, and Bitcoin still went up, what would have people said?
Yeah, exactly.
It's tough to sometimes to take a step back, but I have a feeling that whatever the media says, sometimes it just depends that they're saying at that moment, and that's why the price is movement. And I'll tell you one thing, I know that I know nothing, Paul. And that's the biggest lesson ever, because I know back in the days, I played this stock in 2000. I forget what. I thought I was a genius, Paul. Oh, it's going up, man. It's my theory. This is a new solar, whatever, blah, blah, blah. Years later, I look back and I said, Patrick, you were so lucky. It had nothing to do with that. It was something else. This has happened. And every time I get attached to a thesis, if the price action goes in my favor, it's dangerous because it reinforces that thesis. But then after that, you get distracted from the price action. Then you see the price is far away from the 200-day moving average. You should be taking profits, but you start getting greedy. Oh, no, please, it's just going to go up a little bit more. And then when it dips, you think it's going to go back up. It doesn't do a new high. It keeps going down. And then you're totally trapped. And then your wife divorces you. It's horrendous. You don't want to go through that. So I'm sorry for that.
Now we're going into divorce talk. This is not good. Let's stay away from that. That cost everybody money. All right. Listen, guys, we're going to jump into a couple of questions, and we have a poll coming up here as well, and then we'll wrap up. All right. So we've got Bitcoin crash coming to yes, definitely possible. The audience is kind of split on this, so that's
very
interesting.
Much. Yeah. Wow.
That's pretty cool. A couple of questions coming in. I love this. The guys, when we bring a lot of people on, it says, you brought the real bears on today. We don't always try to bring the bears on. What we try to bring is contrarian views. We want to give you the look from both sides of the table so that you can really do the research yourself and kind of dig into it, guys, because you have to understand all the information has to be presented for you to make a good decision. So think of it that way. All right, so this is coming in from Maurice. Do you think that BlackRock, before entering the crypto market, will crash it as low as possible? Just the idea of BlackRock moving in, obviously their deal with Coinbase. Your thoughts on big entities moving in, trying to position for a possible entry?
Again, for me and Pat, it boils down to the technical chart action. So whatever BlackRock do or do not do, it is already being priced into the charts. And this is the interesting thing, that a lot of people perhaps watching this will mock technical analysis, saying, well, it's impossible to just draw a few lines on a chart and draw any kind of conclusions. And I understand that it's hard to get your head around it, but try and bear in mind that everything that is happening on that price chart is what you know, I know, and every other investor knows about Bitcoin and the cryptocurrencies. So it's already pricing in ahead of time. So actually the price chart isn't just reflecting now, it's reflecting everything that's perceived about the future. And by looking at that and studying that, you can draw conclusions. So as soon as price breaks down, you can start drawing a conclusion. If it breaks out, you can draw a conclusion. Me and Patrick have had a lot of discussions about this kind of thing, and you can spend hours and hours and hours thinking about what your viewers just said there, and that question. But really, you can go round and round in circles, and you end up with arguments. And some people believe one thing, some believe another. You can't prove anything at all by having a discussion about it, but you can prove something by just pulling up a simple price chart and pointing at it and drawing a line. So
Yeah.
I always go back to the evidence. I'm a scientist. I need evidence. People's views, what they think, what they don't think, discussions on YouTube. That doesn't help me. It does not help me make a decision. It might reinforce my bias. If I've got a bias and people are coming out with a reason that supports my bias, then that's just going to make it worse. I'm putting myself in my own little echo bubble. As a scientist, I want evidence, and if the evidence is there on the price chart, if I can see that what some people are saying is true, is going to happen, and you start to get the evidence on the price chart, then it makes that argument more likely to be true, as opposed to the other side of the argument. So it's interesting to know what people are talking about, but if you want to make a scientific conclusion about it, don't just look at that. You have to look at the price chart.
For sure. A couple of statements here. One coming in from Hilldog: was Peter Schiff right? So this is a scenario. Obviously, Peter's probably sitting there with a very interesting look on his face today, I'm sure, as Bitcoin continues to take another hit. What are your thoughts on gold? Do you feel like, I know you guys have been, you've been on the gold channels out there. You've got a position overall in commodities. Is this something that you like right now? I think, Patrick, when you were talking about your charts, you were looking at commodities being a potential real opportunity during these kind of runs, as we see these going down in terms of trends.
Yeah. But Peter Schiff, I would love for him to put up a chart, because I'd be curious to see if he looks at charts for timing, because he would have looked a lot better, his reputation, if he would have just looked at our charts maybe, and he would have figured out that growth stocks were kicking gold's butt for 10 years, right? Nobody should be calling gold going up since 2011, because you see that rising trend line of the SPX it was kicking the producer prices. Like, I would have not been long gold from 2012 to all the way to when it started rolling over today. So right now it's kind of what I said there. His thesis is matching up now with the price action. So he's probably going to be right, because now we're in a transition of these capital flows, and it's not going to happen overnight, Paul. You see these charts, those are monthly candles. It could take 1 year, 2 years, and everybody's going to be all over the place. Everybody's going to get whipsawed to death. This is a choppy water zone right now. People trying to trade this is the destruction zone, and people aren't secure. They're grasping for news. The chart sometimes going up. Oh, there's a rally. Is this the one? And then it goes down. So I think that once gold breaks out versus SPX, which it hasn't done, the producer price index has broken out versus SPX, but not gold yet. So there's still hope for Bitcoin, the growth stocks, to still do okay. But until Peter Schiff will be right when gold breaks out on its own chart merit, and when gold breaks out versus SPX, then he'll be right for the next 10 years, but not quite yet.
Yeah, we're not.
Sorry,
we're not
Peter,
in those
I can't support
zones.
that right now.
Guys, it's been great having you on the show. We appreciate you guys stopping in so much. We'll finish up with our Q&A with our audience, and we do have some sentiment for you guys, so make sure and stick around. We'll drop in our current data on our own Power Index sentiment rankings to give you guys kind of a look at that. But definitely, thank you so much, guys. We'll definitely get you back on when Bitcoin starts hitting these numbers, because this will be either a proving ground or hey, maybe not so much the case. We'll see. But anyway, thanks for stopping in. We appreciate it.
Thanks,
Good
Paul.
stuff.
It was an
Thanks,
honor.
Paul.
You bet. All right, so you guys, again, thanks again. We appreciate you. When you're tuned in on these live streams like this, obviously you guys will get a variety of different opinions from us, and that is our goal, is to bring you the Bitcoin maxis to bring you the guys who are all in on alt and layer 2s, and also the chart analysts who are looking at not only chart scenarios, but also the aspect around the overall macro side of thing. And you know that we do that with, with Gareth quite a bit. So just on to a couple other questions here coming in from Thor, saying one of the reasons why Bitcoin is crashing because of the Mt. Gox BTC, that it did start today, or actually past couple of days. So that there's possibility that that has some relevance in there. I think it still is the scenario of just the timing in the macro. And again, also the ETH merge itself starting to fade a little bit in terms of its impression on where Bitcoin is going. This is coming from Frank Santana, thoughts on regulation. Still, regulation's coming, guys. It is definitely one of those things that is not slowing down. That I think is one of the evident features that is going to be built around digital assets. We have already seen Europe starting to posture around a new entity that would control and or regulate digital assets. I think that's coming here in the United States as well. Most likely this could be put together in the next administration, so be on the lookout for that. Again, these are short runs that we'll see up and down. You guys have already talked and heard me say this before, is that we've seen this downtrend for quite some time. We saw the little ramp up. We had a great chance to make some profits on that, but we are looking for a lower priced Bitcoin and Ethereum. It is what we have been waiting for. It's what I've been waiting for. Obviously, we've played some in and out. You guys, if you're in our mastermind group or in our diamond circle, you kind of already know these things of what we talk about. Make sure, of course, and join our diamond circle. That's the first gateway into the network. It also gets you a couple of emails a week. It gives you some insights, sometimes some AMAs, etc. Also a drop of many of the videos that we're doing. If you're over on the podcast right now, make sure and jump into the YouTube channel. This is the place to catch everything. And it's easy to get involved. Just like the video and subscribe. That way you get notifications if you hit that little bell. And you'll get notifications when these live streams come out. We've got a lot happening. We've got one coming up later today that is going to be looking for a strategy how to play out the ETH scenario and what an alternative would be if you're trying to hedge one way or the other. If you guys want to reach me out on Twitter, it's @Paul Barron. We'll catch you next time right here on TechBath.